Hey guys, it's the Market Sniper. Yep, we're going to take you to a key topic. Boy, oh boy, this is going to be an interesting week. This is a Sunday evening of great interest. This is going to be a Monday of great directional change. Things are already at the place that they start to break. I've got a problem with all these people that are talking about 33 months, 17 months, and I'm going to deal with currently a popular opinion that is a great stock market MELTUP for 40% that we currently hearing. So let's play this clip and let's get that audio barking nice and loud so that you can hear it, and then I'm going to tell you why I do not assess that is the case and that we are in fact already far deeper in than most people realize. Let's hear this.
I am saying the MELTUP starts imminently. It's now.
Okay, that's good clarification. So now, okay.
The top is 3 to 6 months from now. So I think this thing, you can go, I'm calling for, as you know, when you do those numbers, I'm calling for, 40 to 50% upside, certainly from the lows of a couple days ago.
So this was recorded April the 21st, a couple of days ago. From the low side, a 40% upside call is being called here. Let me just replay that again. I put it on 1.5. Let's do 1.25.
Days ago, in less than 6 months. I mean, that's absurd. I'm fully aware that I'm making a crazy call.
Let's hear it again.
Clarification. So now, okay.
The top is 3 to 6 months from now. So I think this thing.
So a top's going to be 3 to 6 months from now.
You can go. I'm calling for, as you know, when you do those numbers, I'm calling for 40 to 50% upside. Sir.
40 to 50% MELTUP inside 3 months, possibly 6.
From the lows of a couple days ago, in less than 6 months. I mean, that's absurd. I'm fully aware that I'm making a crazy call.
Okay, in my opinion, it is indeed absurd, and in actual fact, I don't think anyone who's a technical analyst would easily accept that. So 50% in 3 months, or 40% in 6 months, somewhere in that range. Let's go straight to the charts and have a little look. This is an equities bull call that is being made. This is the debt markets. I'm going to first give a quick little intro to the debt markets and remind people how this has been doing. Again, we are the first and only people that a substantial period ago during the COVID blow-off highs said that is the final MELTUP of the debt markets, not of the stock markets, the beginning of the end of a 40-year bull cycle that is now over. And this was the yields that you've been getting on those same debt instruments over the better part since 1980s. From the high, and we say again with a log scale, let's put that into log scale, and I don't know how many times I've done this, but people don't realize the sensitivity, how huge a move that was for the pandemic in terms of percentage change of the yield, which was also the blow off of the capital, because there's an inverse relationship in bonds, and how absolutely huge this MELTUP in terms of reversing that sensitivity. The log scale gives you how big a plummet. Technical analysis bookends with final capitulations and blow-offs, end of trends. We've already had the end of trend on the debt markets, and if you think you're still going to have the reversal and the beginning of what is going to be a secular nightmare bear market for bonds, and in that environment you're going to get a 50% MELTUP on stocks within 3 to 6 months, I think you're slightly deluded in terms of what's actually being shown to be the case on the charts. So let's go have a look at some of those equity indices and talk about the charting. If you looked at charts, the one thing that always tends to happen is as you start to get high volatility, it is usually bearish in terms of the technical assessment. Whenever the volatility starts to climb, it is inherently bearish. Now, I'm not saying it can't happen. I'm just saying as a probability assessment, listening to that as advice and looking to jump in the traffic that is collecting pennies in the fast lane on the Autobahn where there's a Porsche Turbo that's going to clout you at 330 kilometers an hour, picking up 5-cent pieces in the fast lane. This is the last stipend of, it would be, if it were to happen, the last stipend of a bull market blow off, and it would be exceedingly dangerous, because to get this wrong is when the big smackdown has come. And if you haven't seen big smackdowns, I ask you to revisit the events of March 2020 as an overall event for a bit of a sell-off. There you have 29,400, and you wake up, boom chakalak, 18,000. If you want to measure that, here's a ruler, and I'll do it for you. Here you go. These were deeply functional breaks in the market. Now, let's get a little bit of space on that. That represented a 38.2, and I've kind of underdrawn it. Let's try again. So from the very top there, come on, man. To there, to the absolute low, you've essentially had 38% loss in value. Now, what I see actually coming, which is the end of the debt market and the acknowledgement of that fact, is likely to lead to, in percentage terms, actually a greater event. And this is what's absurd, and I'm going to be absurd. I'm going to follow the trend of being absurd, and I'm going to say this is going to be a greater event than when they stopped the world economy and SMEs were largely shut down by the corporatocracy elite that were allowed to continue to operate. So that is my take. This is going to be in excess of 38%. So this is what we've had. Let's just get these charts under control. They're getting a bit haywire here. Let's drop down to the daily and have a look at that structure. What typically happens is you have low volatility periods, grinding. There is an element of exhaustion that goes with this, and this is what you've had over here. Let's do it in our favorite color, why not so? And you have an element of exhaustion like this that has been grinding up. This has all interacted a number of times with a key level that we've identified at the 33,600, the blue level line. You then get away a little bit. You seem to break out, and you don't run down to 36, and you make highs on a higher highs, higher lows basis, and you top out in and around the 37. Then a nasty sell-off. It reacquaints you with that 33,500 level. You get your right shoulder bounce. Now, so many people will say, that's not head and shoulders. People don't understand. The best head and shoulders are actually quite complex. The very simple ABC diagram structure, most people are, and can I say, shorting indices, equity indices over the last 40 years has literally been a ticket to the poorhouse. This was a buy the damn dip market, as was the bond market from the Volcker years, from 81 to 2020. And that was the end of the 40-year cycle for us in terms of debt. This is what we refer to as complex shouldering, which is long, flat, low volatility, but grindy first shoulder. A really huffing and puffing complex head where you make a marginally higher high on the second one and get sold off hard. Then higher volatility, wilder swings before you start to roll over. And in our opinion, this Monday has started really badly in the Sunday sessions. So this is the Dow Jones, and you are actually back down at this 33,000 level. To call 60% in this thrashing volatility environment where you've just had very high VIX start to be introduced, on top of the fact that actually relatively, the VIX on equity has been substantially less, and ignoring what has been going on the bond market until recently. While the VIX on the bond market, which is known as MOV, has absolutely been shooting. And you've had this parallel universe where equity said, we don't care, we don't care. Oops, suddenly we care. Because the debt-based system is tied to the currency markets. We've called you the yen long. We called you the USD ruble long. We've called you the dollar index long through 100 when it was at 94 and everyone was bearish the dollar. When everyone was telling you the dollar was down, we're telling you the dollar is long. We told you it'll go long it against the ruble, go long of it against the yen. That was in September of last year, 8 months ago. and you're hearing zero hedge and the like of them coming up and say, we were saying more than a month ago, yada yada, fish paste about how the yen is going to be a big deal, their divergence in direction, the fact that they're doing curve control, all of this. This was in the charts long before. Let's show you a couple of segments actually from their article that we cut out. This is what they were saying. Here we go. This is zero hedge. Let's take that off. It was exactly 1 month ago on March 24. Well, let's remember, zero hedge is before Bloomberg and all the rest of them. They're one of the earliest to deal with the big issues. You got this trade in September from us last year, 2021. No one is talking about it, they say. No one is talking about it. Picked up on this line of thought, Albert Edwards of Soc Gen. Albert Edwards is 9 months late. I've had a transgendered baby already. I can't get over the fact that we don't get noticed. I was reading about other guys, FX, the best FX economist, and he's some brokerage that the Bloomberg is giving business to Bloomberg and being given an award, and he's finally talking about shorting the yen. And I'm like, man, we'll never get credited for being 6 months to 9 months before the zero hedge articles, never mind the Bloomberg and the mainstream financial presses articles for what's gone on. So what else did we say in that same video? That now that everyone's talking about the yen, it's probably going to have a little bit of a rest. And you know who's going to get hot? The Korean won. And that's one of our others, the USD Hong Kong dollar. Also, all in these videos. This is FX and this is debt failure. This is the difference between the alleged path that America claims to take under the Federal Reserve and has done so far 0.25 interest rate hike, which is substantially more than Europe, who may do tools for curve control too, and Japan. And hence why Japan is getting clobbered. This is going to be contagion into all the Western friendly Far Eastern currencies. Hong Kong dollar, potentially the Taiwan dollar, and of course the Korean won. So watch out. I'll take you into those charts. But these guys are late. There's a schism in monetary policy. They come on the narrative. We take the trade technically long before, and the narrative follows. Yes, there is a difference between them, and the story emerges out the mist. Once the trade is already run from 107, where you could have been long with us in our community. By the way, it was a September free view on the Market Sniper. It was being discussed in our community for 6 months before then. In fact, we were initially wondering if it was going to be in the opposite direction. We were watching it. A big move was coming. We saw it. We saw it that there was going to be a breakout well before the others. The biggest story no one is talking about. That's because you, my friend Albert Edwards, unsubscribed to the Market Sniper. If you really want the news before the news, you should get subscribed to the most insightful macro technical forecasting reset specific channel on the whole web. That is a goddamn fact. All these brokers, all these experts, all these Zoltan, the genius, everything he said, we've been saying for 10 years, and the key trades we've given you 6 months before these guys are even showing up. Edwards turns his attention to the yen and the yuan. Surely all of us working in finance realize by now that something's likely to snap in the financial system. And the other thing that we regularly say is that the momentum and rate of change, the rapidity, that's the speed and momentum of current market moves, and the polarization of the Fed allegedly being hawkish and the Bank of Japan being dovish, will obviously see a complete dichotomy in directions. And this is what's driving the USD JPY. Plus, we've provided targets already for that you'll see 136 in our opinion being run. Yes, you could have a rest then. Yes, something will break, and yes, the Americans will be the one that'll roll back their economic activity rather than the Japanese starting to tighten and giving up curve control. It will break very early, and it's in the process of breaking. And one of the key charts you should be looking at for checking out why it's already breaking and you're not getting another 40% on equity right now. Jesus, in 3 months, I mean, that would be unbelievable, unbelievable. Imagine being leveraged long the SPY and getting another 40 or 50% in 3 to 6 months. That would just be like, wow, that is on top of an already hyper pump market that's at all-time highs, market cap to GDP, extremely high highs on any number of levels in an inflationary environment that is hyper stagflationary, a zero earnings, an earnings goddamn depression, because the retail world can't buy your stuff anymore. Their disposable income has never been more squeezed by the higher gas prices, by everyone and sunder. And yes, this may rally, and you'll come in and you'll say, you're wrong, we're rallying, everything is cool. It ain't over. This is a real risk, even if it rallies during the course of today and it just has a ropey start on Sunday. Look how high it's already rallied. It hasn't invalidated this potential head and shoulder structure. We call these the armpits. We do a very tight defining of the head and shoulder due to complex structures and key levels of significance. You can learn about that in our community, where we are discussing this real-time practical trading, building wealth in reset season. And by the way, if you just think it's the Dow, let's just show you the other indices. This is all these indices apparently are about to go melt up for 40%. Here's your SPY. How'd you like them apples for a break on the 427 neckline? There's your left shoulder. Write it in for you. Give me a text box, will you? Write it in. Left shoulder. I think that's my left hand side. Check it out, Funk Soul brother. Yeah, that dyslexia is kicking. Let's get the right shoulder up. Right shoulder, and now you know exactly what we're talking about. Again, there's some element of complexity in it in all instances, but this is a key level, 4,270, 4270. Again, left shoulder. More grindy on the up legs, then a little bit of a release. Makes higher highs, but marginally higher highs, then has a real spill, comes back down to the levels over here. That's a second hit on this level. That means you went higher and you fell harder. Look at that momentum, a small zig and a zag and then down. You're breaking this channel range for an extended period that came from way back then. A weak bounce, still a lot of volatility, kind of thrash up, and you've made a big bulky right shoulder, and now you are throwing it down, and this could be a triggering event for this head and shoulder. By the way, I don't just think that's the target. This would be a secular sell-off that would go for quite a bit if this rolls into the debt crisis. By the way, we're also going into summer months. It's a terrible time. Sale in May, go away until St. Leger's Day. So you've got debt markets unraveling. Everybody that wants to go on holiday will have to assume defensive positions. Nobody's going to want to leave a book that's bleeding out of its nose, its backside, and its ears while they go on holiday. Defense, defense, defense. And by the way, this is another key attribute. Someone say, your head and shoulders look funny. That's not a head and shoulders. I get all of this in this time because you don't understand our content and how we do head and shoulders and how they correctly work and how you should define them. Everybody wants diagrammatic perfect. This is complexity. Much higher volatility on the right shoulder. More thrashy markets. Major pump, major dump. While this was walking, talking, having a little tool time. Much less lower volatility. This volatility increase, if you don't believe me, there's indicators for it. Let's just put them on and you can have a little look. Indicators, volatility, H. What you should be able to see is that the volatility is expanding. Volatility is usually the code CNBC talking heads version of saying it's going down. They don't like to say bear market is going down. Compare it to that when you are doing your left shoulder here, and now your head and your right shoulder. You are in an upward channel trending and you're busy going up inside that channel after a little bit of cooling off. This is an increase in volatility. That rarely means, well, hey, pumping for a 40% in 3 months, pumping for a 50% in 6 months. No, sir. No, sir. You don't go into 3 of the major indices with potential technical head and shoulders, and these are head and shoulders. For all those that are going to post in the comments, not head and shoulders. These are head and shoulders. This is the NASDAQ composite, very, very similar to this, and it is also down at a neckline. By the way, we've been short ARK. We've been telling people, be short ARK. Look at this. Look at this. Look at that increase in volatility. This thing is trending up, and it was low. It was trending down during this right shoulder period, and then you had a channel, you were squeezing higher, then you made a high there, you couldn't make a new high, you had a bit of a rest there, you were testing that level, you couldn't hang on, spill, 2 legs down, you're back at the 12,750, which you were there. You've round tripped on a macro, and you've come down in a fraction of the time back to your 1270, 750 level. What took you in grindage on the way up. There's the 2 triangles. This hypotenuse is far steeper. This is illustrating major loss. How far did you rally? Super up and fast down. You can see the speed compared to these moves which were lower volatility. High volatility turning up in an upward trending channel. That is not basing markets for a 40 to 50% run in 3 to 6 months. Markets that are about to do 40 to 50% usually go from a very low, calm volatility period into breakouts, not in high thrashing volatility with head and shoulder type structures. Let's put on that right shoulder and stick him in the right place. By the way, that yen is having a pullback. And who's taking over? You guessed it, the Korean won, also given to you on the 6 macro FX trades you should be in. Left shoulder. So we're going to go show you that in a minute. So that is, we've looked at Dow 30, the S&P. This is the composite NASDAQ, and this is the NDX. Same goddamn thing. Left shoulder, head, right shoulder. Increased volatility. Increasing volatility. And throwing it down. These are not positive structures on increased volatility. What will have to happen is the Fed would have to come out after talking non-stop hawk and go, yeah, we were joking. We ain't going to do it. We may do double increase, but no, maybe not. After saying that actually 75 could be the new 50 basis points. So unless you really think, and they've been given license, because everybody now is talking about inflation, Bidenomics, we'll tame this inflation, he says, we've got to do it to tame the inflation. You've got politicians calling, and they never call for rate hikes. They have got a license to tighten until things break. And the most important chart that has got nothing to do with indices and nothing to do, in my opinion, with 50% in 3 to 6 months is high yield debt. High yield debt is the pig of the debt markets. It is the absolute pig, and the Fed stood behind it. The Fed stood behind it when it was in a fail, when we last shorted the high yield market. So let's show you that. Debt markets, let's bring it along. Here we go. HYG. So I'm going to take you far out to this one. This is the monthly. We're going to, in fact, probably 2 weeks we'll do. Weekly 2. Now, this is one we called. Was going to be an absolute spiller, a complete thriller, all the way from Manila. That's right. We said it. We told you it would happen. And then, on its way, in the spill, this was a precursor to COVID. We were short in September. As the problem started in the repo market, we got short high yield. This was very close to the 88 eventual high, and we had a working stop at the previous high at 89, and it rolled over, and then it started to spill. It was absolutely throwing money at us. It ran our second interim, and then boom, Fed intervenes. We will support junk debt. Guess what's happened? They cannot, for the same reasons, do the support of the junk debt market in the same way again. It's been written. You did that once, you cheated, you did something you shouldn't have done. It's not a price discovery mechanism. The shit should have been allowed to drop and die, and you didn't allow it to happen. And I asked Daniel DiMartino Booth in a recent interview, which we'll be releasing shortly on this channel, where you need to hit always, because we are shadow banned and people don't like the cut of our jib sometimes, and you've got to keep hitting always, because you will get unsubscribed and your notification will be downgraded. And we asked her, but what if they just do it again? Because guess what? I want to buy my puts again, because after this rally we lost a couple of almost a year, and they were back where they started. They were losing value, and in the end I eventually closed them. We are back down, triggering at our key level on the crappiest debt of them all, and there is a shelf just above junk level of bad US companies that borrow to pay dividends, aren't making earnings, have added to debt, or haven't grown revenue and are contracting in revenue terms, profit terms, and increased debt, whose share price is still up on where it was a decade ago, and who are in deep trouble on their borrowing, and they're one level. The ratings agency are absolutely sleeping on the game again, because that's how it's played. It's part of the game. You don't get the business if you say nasty things about companies, even if it means telling the truth about how sick and totally indebted they are, and how they won't be able to make their payments if there's adverse credit event markets. They don't do it, and they are all kept. Pensions will not be able to hold junk debt. There's a huge shelf of debt that should be reclassified as junk, and that isn't. And the junk is real junk. The high yield is real junk and has been paying ridiculous rates, and we have forecast that this, if it was allowed to do a full price discovery mechanism, would definitely run the 49 level HYG, and quite likely run very, very close to zero if it wasn't backstopped by the Fed over here. Will it be backstopped again? And the answer DDB gave me, Danielle DiMartino Booth, was they need a whole new justification and reason, because it's been written that they can't and shouldn't have done that, and they won't be allowed to do it again. So, should you be shorting debt? Well, that's one question, but the Fed could jump in again and spoil your debt trade. But at some point, they've got to walk. At some point, they let the debt Ponzi fail. And this time, they've got license to play until things break. This points to potential for the dollar to remain strong. The dollar index has been a long. We called it a long. We kept people long. We kept saying on that aspect, Brent Johnson is correct. Don't go along against the commodity currencies generally, although the dollar will still have surges of strength. You want to target the euro, the yen, the Korean won, the Hong Kong dollar, the Taiwanese dollar, and we started with the Turkish lira, before even the ruble, and every single one of those has dropped. The Turkish lira has run, and it's had an epic run. The USD ruble made target and overperformance, and you needed to close it because it's come back down, because they back commodities, and I can see that long term turning into quite a potential decent currency. But this debt market falling out of bed on the worst quality of debt is not the environment that doesn't lead to system breaks, and is not the environment for, in 6 months, the market to do 50%. That means every indice I showed you is going to do half again in a blow-off, while the junk debt is falling through its own backside. You are not very far away from them potentially intervening. When it spills fast. This is a triggering event. You went from here, 1 candle, 2 candles, 3. Done. They intervened. 3 fortnights and it was over. You're talking 6 weeks from one side of our funnel to a triggering event to running to its absolute low and already beginning its rebound because they couldn't let it happen. How much more will they wait until they get it break? It is triggering those same levels again now, and we are saying to you, if it's allowed to run, it will run through 49 and a lot lower. This junk debt is not worth the paper it is even written on in many aspects. Hertz, after a while, didn't even make first payment on a huge tranche of hundreds of millions that they borrowed before they went can't pay on their most recent. There is absolute garbage in there. There is absolute garbage in the junk bond debt. And let me say to you, the failure of the debt markets is going to cause derivative problems, bank problems, everything you can conceivably view, potentially repo market problems, potentially margin calls, potential hedge fund failure, the quadrillions of counter, held, magic circle, cross liabilities, the obscene amount sent to BNP Paribas, 25 banks in the September, October of 2019. 3 months, that was when the yield curve inverted, 33 months from the first yield curve inversion, when that happened, which within 3 months you had COVID that allowed for stimulus to occur in March. And it was already spoken about in January, and the lockdowns were already official in March and are being enforced. So the entire January and February, the narrative was already out in the market, was absolutely collapsing, and the cure was to lock everybody down. Guess what? They're going to have to pull something really big to equal that, and it could be some of the same and some other things, such as bank-related dramas. Look at those French banks. Look at those Italian banks. Look at it all. The entire Europe thing. In total, 48 trillion was provided to 25 banks, the 25 largest banks, with some of the biggest ones nearly 4 trillion. And it included JP Morgan, Goldman Sachs at 2.8, 2.6s. It's an unbelievable article. I've tweeted it out if you're following us on Twitter. It's been totally suppressed and no questions asked about the single biggest funding. The American taxpayer was funding dilution to give emergency loans. 48 trillion. You have no concept of how vast a number that is. You're talking about 3 times your official fake number GDP. 3 years of every single service and item ever sold that could be rolled up and in the GDP number. That was given very quickly by Powell and the rest to shore up the repo markets. You are sitting on debt collapse. It is a debt-based system, and it is tied to the currency markets. And if the Fed is going to tighten, they are going to break something, and this break is coming far sooner. As they eventually commented, as I highlighted, the pace of momentum, the absolute rapidity was the phrase they used, is extreme. Okay, so let's go do the deep dive on currencies quickly. This is the dollar index. We've said 110 for the dollar, at least on the upside, and that it's already in a break for that to happen. People all such dollar bears. Oh, but they printed 7 trillion, da 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 da. It's a leper colony, and initially the original world currency gets benefits for being the base currency of the world. Yes, they've done everything to undermine that. Yes, their D-Day is coming. Yes, to absolutely everything. Yes, they took truckers' money away from them, and it's undermined the Canadian dollar and the SWIFT banking system. Yes, they took the Russians' money away from them. There's the trust and the rule of law is absolutely going away. Watch out for the John Titus rule of law YouTube that we'll be releasing on the Reset Sniper on Odyssey, where you will see the utter undermining of the rule of law is the beginning of the end of an official system that people can trust, that is completely neutral and doesn't take action against people and doesn't make moral judgments of bad actor, good actor. The trustless concept. Yes, we are in the end and death of a financial system. So this dollar is in a breakout, and it will continue to outperform these first world non-base currencies of standard, such as the yen, the euro, and some of these other Western Asias and FX emergings, as you've already seen with the TRY and the ruble. Although I've already said about the ruble, you had to take your profits on that one, and we had targets for you. So let's talk about the USD Korean won. The USD Korean won is at critical levels. Critical levels. We've went on to Real Vision. We said this one is going to be a break, and you will probably double. Who makes? I mean, look. full credit to Hunter for making ballsy calls. I like people that are prepared to stick their name out, sound stupid or bold, and make ballsy calls. Full credit to them. I just think that's the wrong ballsy call. In actual fact, we've made probably ballsier calls that are even more peculiar. We went on Real Vision and said, you will get the halvening on the Korean won. You will get a halvening on the Korean won in terms of its buying power. It is going to go to 2,100 and potentially beyond in a collapse, mega spike type environment that's going to represent some form of an Asian crisis that especially the westernized Asians like the yen and the Korean won, the friends of America, will face. And I think fear for Taiwan on that one, and certainly Hong Kong as well. These currencies, the Hong Kong dollar fatally flawed, reserves fatally low, and these are the big trades that you can get on. And this guy is going up, uppity up, and it is back at key levels where it failed before. Fail, fail, fail. Once, twice, 3 times, a lady, boom, bosh, and up you go. I think this could be the one. You might get one more small pullback. I don't think you're getting back down to these levels. This was brought about by the stimulus that brought the dollar down by that much, the 7 trillion that they printed. They are not going to be printing. They're all about hawkishness. They're all about tightening, license to break, license to kill, and they're going to kill. And they're going to kill the system, and we're going to see which part is the weakest and breaks next. And I wouldn't be surprised to see any form of the banking system involved in that, from European banks, Far Eastern banks, and American banks. I wouldn't be surprised to see derivatives. I wouldn't be surprised to see trillion repo rates being done. The game is to break the functioning of the financial system so that they can go into a super next stage stimulus, and that is when you load back up on your gold and silver, because gold and silver will actually sell off in deflation. The equity markets can sell off in this deflationary event. Go check again the COVID moves. Have a look at the NASDAQ, what it did. What did the NASDAQ do as an indice in the COVID-based events? Let's have a look at the NASDAQ composite. Here we are, I think that's it over there. That's 18 Feb. Let's see how it did. Measure me, measure me, measure me, he said. Grab that. Come on, give me the measuring tool. %32%. And I think this one's bigger, guys. I think this one is bigger. How far have we gone down so far? Don't forget, still a head and shoulder. You've lost 22. This is first leg stories. This is first leg stories. We can do a whole lot worse on that. And that is with a debt failure. You got this fall, you are setting up for the debt to fail again. The debt is getting ready to fail again. So, Korean won, reassert, warning about the USD Hong Kong dollar. That's going to be real in trouble. We've warned you about ARK and taken puts on ARK. This is a throwdown. This is a throwdown, and it's a beginning of something that could get far uglier for Kathy. This entire up leg, this notion that she was saying, well, it wouldn't shock me that, you know, getting in now, you'll get 60% return from here. This is just cheap as chips. All of these things are far too soon. People have been too well trained on buy the damn dip now. In the bond markets and everything, the amount of people I've said, buy calls on debt. No, it's the end of the debt system. Yes, it might get a little bit of a bounce on deflation. How much do you really want to collect? All the risk to the downside. The debt, you could have a debt jubilee. It could be all written off. You could be holding the notes when they get signed off. For what? For a small gain when you have a collapse period with a bit of a, you know, the yield goes down, a bit of capital gains in bonds when everything else goes down. Rather be in cash, rather be in gold and eat a little bit of deflationary sell-off, or be in cash. If you don't think the banks are going to be hacked, be in cash if that's your game. Do not, because you're relying on getting out. You're relying on getting out of that debt-based system. For us, this is a serious issue, and there you go. If we just draw that, that was around 2.618 that you got the top. You might have actually just done the 3.618, and in my opinion now you are doing the exact opposites on the downside now. This is now Elliott. We're having problems with responsiveness from TradingView today. So this is Kathy's arc. You could easily go to 1.618. You could easily go there, and you could go further. And there's just high beta tech stocks. So this is going to be a fascinating week, and I can tell you a lot of the risk is to the downside. And people say, oh, it's because so many people are bearish, we have to go up. You know, the sentiment indicator, people are concerned. Every now and then everybody's right, and this is one of the most telegraphed, monumental monetary policy pinch points that only ends in damage. They've committed themselves to tighten in a failing debt market. They have committed themselves to tighten in a failing debt market, and currencies are moving to reflect that. The ones that are tightening versus the ones that are not. The junk market, it was rolling over. This is all about to blow up. It's not the time to play, oh, I'll do a super quick blow off and make 50% of my money on the equity markets. I find it very frustrating. I think it's exuberant, and I think the charts don't even support it. The volatility is high. You would need a major calming in the volatility. You would need a nice rounded bottom, and then you would want a proper breakout on the equity indices. Does ARK look like it's going to deliver you that? Did the NASDAQ, when I had it up, look like it's going to deliver you that? Did the SPY, which is traditional businesses, look like it was going to deliver you that? Every single one of them is in a state of higher volatility. Plus you have junk bond market absolutely falling through the floor. So yeah, okay, let's, is there any of the other markets that I was going to talk to you about? Look, even, it's such a risk-off market that even Bitcoin, that's supposed to be limited in number for those that are crypto friends, we'll do an update on Crypto Sniper during the course of this week as well. Even Bitcoin can't get a bid to stay above, take the eye off 40 grand. Do you think that's positive? Do you think it's a positive chart? I don't. I don't think it's positive right now. That is an inverted hammer. That is a channel. It is not a strong chart. It is not a strong chart at all. That is a range trading, and you're on the bottom of that range. Of course it can zoom back up there and still be in the channel and churn for a while and eventually square up. And part of me hopes that it'll do that. But we've got to go through the fire. We've got to go through this fire. Anyway, so what are we calling next? Let's just summarize. Further downgrading of the debt system. I think they're going to try slow the disorderly loss of value in the debt markets. But they can't hide in the currencies that you've got. Central banks that are diverging in policy. By not being, we will do curve control, and by saying we'll tighten, America has set itself on a contradictory direction. What has this done for metals? For those who want the metals, it's put the silver back down again. Why? Because it battles to go up in a deflationary environment. It battles to go up in a deflationary environment. But in my longer term view, it is still better. Look at this pullback currently at the moment. Because of the euro weakness, it's a bit better a chart. In the long run, this breaks out to the upside. But will you get maybe a chance, a dip lower? You probably will. And should everyone buy it? Absolutely. What will be the solution? You need, the market is a discounting mechanism in the 6 months ahead. They're not waiting till the Federal Reserve has done 3 2.5s or 1 2.5 and a 0.5, 50 basis points hike. They are pricing in for that, and that's what the bond market is doing too. We've done very, very well with uranium, but look how it's reined back the commodities at the moment. This is what's happened on the commodities. You've seen oil get a little bit stopped. It was at 140. Now it's trading, around the 100 mark. That's Western Texas Intermediate. That's Brent. You're looking at essentially a congestion period now with quite a flat bottom, a descending triangle. Why? Because they're going to do a demand killing event, and the consumer is going to be rocked, and he's not going to be buying cars, and he's not going to be traveling, and freedom is going to be the pig virus, the bird virus, the virus of whatever, the virus of conservatism, white male bad virus. All the viruses are going to come out, and freedom of movement, and the planet's being killed. In the meantime, agris have been super strong, but they're also just recently being reined back. There were some people speculating that the events in China have been there to rein back the rate of climb in the commodities. They can't stand the commodities going that high, but Robusta coffee is getting going again. Look how it's done on a weekly basis. So much for that pullback. Nice, look one way, go the other way. It has been a real great bull. We called this bull on this setup over here, way back here. We said it, go get long here, and it gave you a real nightmare start, a break and a pullback before it went, and then it just kept on going. So it's had a minor pullback in a broadening structure. That will end, it'll square up, and it's going to break out to the top side. And then you will be back setting up your next bull move. But first, a little bit of fear. Okay, guys, don't forget, pop over to our community. We're looking at building wealth and protecting wealth in reset times, and getting the macro right, and not trading long stocks, not trading long debt, even though it may get a bid and climb up and rates will have a stop for a while. In the long run, they will print, do curve control, they'll do everything to try and maintain the debt market. They're going to kill the consumer, they will kill demand, they'll probably do some sort of pandemic that'll stop your travel because it worked so well last time, and they've already introduced the concept. They don't need to teach old dogs new tricks. Then everyone will muzzle up and pee on a post when told to, and that's kind of where you've been trained. And there will be other aspects. We may have a banking failure, banking system, bail-ins, all sorts of things. You want to kill demand, take everybody's money out, and then they'll riot. And there's food's a problem in terms of supply chain. Oh, we can't do this now. They're de-globalizing, so you can source your core aspects from your core supply chain components from far less nations, because now it's Russia bad, China bad, Belarus bad, this place bad. Well, you're talking about some of the biggest wheat producers, uranium producers, nickel, you name it. It goes on and on and on. So let me leave it here. We look forward to seeing you. Book a call, costs nothing to chat. Build your wealth, because there's some killer trades. You could have been long the yen, and you could be long the Korean won. We're giving you that absolutely for free. There's other things that are being discussed, and there are real opportunities to take wealth changing events. That's the key thing. The people that understand the markets actually could do exceedingly well during reset. It's going to be a polarizing event. For most people that are passive are going to get obliterated by it. With that, I thank you for watching. We appreciate the likes and the shares, and we'll catch you next time. All the best for now.